Welcome again. I hope all of you had a wonderful lunch, and please continue to enjoy your lunch. I'll get started now. The Lubar College of Business is extremely proud to host the Bradley Distinguished Lecture Series, which has been an intellectual tradition in Milwaukee for about 35 years. Through this series, we bring internationally respected thought leaders, scholars, policy experts, and business leaders to speak on major issues related to the global economy, such as budget, deficits, housing, taxes, inflation, and more. These programs would not have been possible without the generous support of the Lynd and Harry Bradley Foundation, a private foundation headquartered in Milwaukee, which is based on the founders' desire to preserve and defend the traditions of representative government and private enterprise that have enabled America to flourish intellectually and economically. We extend our deepest appreciation to the Bradley Foundation, both for its support of the series and for its commitment to our community. Please join me in thanking Ingrid Gregg, Senior Program Director, and Gabe Conger, President of the Bradley Impact Fund, for continuing to support this valuable intellectual series. I don't believe Ingrid and Gabe are here, but we do have a representative from Bradley Foundation, Jim Berry, the director of Bradley Foundation. So please convey we are conveying our thanks to you, and please convey that to the team there. Thank you, Jim. So we are also pleased to welcome Dr. Douglas Diamond as the keynote speaker. Doug, on behalf of Lubar College of Business, thank you for joining us today to share your expertise. It is now my pleasure to invite Dr. Kanti Prasad to formally introduce our distinguished guest. Dr. Prasad is Emeritus Dean and Emeritus Bostrom Professor of Entrepreneurship and Innovation at the Lubar College of Business, where he was a faculty for nearly 50 years. So he's also well known to our Bradley audiences, having served as the director of the Distinguished Lecture Series since its inception in 1991. Kanti, thank you for your stewardship of this series. Kanti, over to you.
Thank you, Kaushal. 1991, oh boy. I would also like to convey my sincere thanks to the Bradley Foundation. I wrote the first Bradley grant proposal in 1991, so it has been a long, long time. And we really appreciate their generous support for this Bradley Distinguished Lecture Series. For over 35 years, as Kaushal mentioned, this highly respected and popular series has been inviting internationally renowned experts for their views on U.S. economic policies that will strengthen America's economic competitiveness and free enterprise, and showcasing the cherished values and institutions that underpin American exceptionalism. Our special thanks to Bradley Foundation's President and CEO, Rick Graber, and of course, their outstanding board of directors and their outstanding executive team, in particular to Ingrid Gregg, who is the senior program director, who has especially been a great source of help for our series over the years. Coming to today's program, many of us have seen the painful effects of crises in different sectors of the finance industry. Thankfully, I wasn't around to witness the Great Depression of the 1930s, but I certainly witnessed the savings and loan crisis that lasted from the late 70s to the 80s, and the mortgage finance crisis from 2007 to 2010, and saw the havoc that fell on the economy and on people's lives as a result of failures of financial institutions. Our Bradley speaker today, Dr. Douglas Diamond, he's one of the world's top economists who specialized in the study of banks as financial intermediaries and study of financial crises and liquidity. He is the Merton Miller Distinguished Service Professor of Finance at the University of Chicago's Booth School of Business. He, along with two other distinguished economists, Ben Bernanke of MIT and Phil Dybvig of Washington University at St. Louis, were the co-recipients of 2022 Nobel Prize in Economics. The Nobel Prize Committee at that time noted that their research collectively has significantly improved understanding of the role of banks in the economy, particularly during financial crises. It commented that their analyses have been of great practical importance in regulating financial markets and dealing with financial crises. Dr. Diamond did his master's in economics at MIT and his doctorate in economics at Yale University. We are very pleased that Dr. Diamond has accepted our invitation to present the Bradley Distinguished Lecture today. His topic is a special dimension of the financial markets, dealing with mortgage finance policy, monetary policy, and financial crises. The UWM-Lubar College of Business and the Bradley Foundation extend a warm welcome to Dr. Douglas Diamond to Milwaukee. Doug?
It's a great honor to be here. I'm Doug Diamond. I often talk to a bunch of supervisors and regulators, scolding them on making lots of mistakes in their day jobs. Not your fault, so I'm not going to scold any of you. So today I'm going to talk about how various attempts over U.S. history to sort of prop up housing finance markets, improving access to mortgage finance in particular, how that interacts with normal monetary policy, and how it has a very complicated, dynamic, symbiotic relationship with financial crises. So I'll give you some history, just a very high-level history of how U.S. government intervention into mortgage markets and other housing finance markets evolved, sort of what problems they were trying to solve, and then follow through time and see what problems they caused. Then, after we saw what problems they caused, we try to do better, and we react to some things, and then that does something for a while. Then it causes new troubles of its own, and we'll take that all the way up to the present. Okay, so and if sort of the all of us who are involved in business should be interested in how financial crises, how the seeds are sown for future financial crises. It turns out a lot of them work through housing policy, which is surprising because it's not the top of the list of things that worry people. And it'll help explain, if any of you are thinking about moving or buying a house, even worse, how the housing market today is so frozen and how that turned out to be a consequence of various types of policy decisions made over the years. Okay, so about me. So I've been at the University of Chicago since 1979. I've been working on financial crises. I'm a theorist. I don't do any empirical work. And it uses math. I apologize for that. But basically, the kind of work I do is to try to say, when you see something happening in a financial crisis or in a normal period, how should you interpret what you see? So the models, I build models. The models are ones you sort of keep in your head and say, that looks like this type of a crisis, or that looks like that type of a crisis. So I've been working on banking and financial crises essentially for 50 years. And it'll come up in the future. So almost my whole career has been working in universities, at the University of Chicago for all but 3 years of my career. But when I was in graduate school, I spent 3 long summers at the Federal Reserve Board in Washington, D.C., and it turns out that's going to relate to today's talk, so I'll get back to that. Okay, so that's why I'm here. So basically, real estate finance and interventions into real estate finance and financial crises, they sort of go together in a cycle. And it's not really like love and marriage, it's more like thunder and lightning. They sort of happen together, one comes before the other, in that case, all the time. You know, the speed of light is faster than the speed of sound. But sort of how far apart they are moves around. So my main research has basically not been on housing finance. I've never written a paper on housing finance. Turns out there's another guy named Douglas Diamond, Douglas B. Diamond Jr., who does. So I get every so often papers to referee on housing finance, but I always send it to the other Doug Diamond. But I've never done any of this. So I work on financial crises, but it turns out about 80% of the financial crises can be thought of as part of them having to do with previous housing finance policy in the US. So just to give you a hint of where we're going, this doesn't fit all of the screw-ups that the laws made, but we'll see there's a good analogy between some of the interventions into housing finance and the government subsidies that are provided for flood insurance in a floodplain or right near an ocean. Most of you understand, if you get cheap subsidized insurance right on the Gulf of Mexico or right on the Atlantic Ocean in Florida, you know, you were going to build a house right up to the beach as close as you'll let them do it. Or if you live along the Mississippi River, which floods every so often, if you have a flood insurance, you'll build houses. You'll build too many houses. So what I'm going to say is that a lot of the government subsidies to 30-year fixed-rate mortgages, which will be the main thing I'm talking about, a lot of the subsidies to 30-year fixed-rate mortgages are just like that flood insurance. They're giving an unfair, non-market advantage to this mortgage, the 30-year fixed-rate mortgage, which has a good side and it has an evil side. And we'll see, it does have a good side. It's not like 30-year mortgages are something we wouldn't want to have, but it is the case that we should think carefully. So housing finance and financial crises, they sort of go together. They follow a cycle. So one comes before the other. It's not clear which one's the cause and which one's the effect. They're both causes and they're both effects, it turns out. And each time there's a crisis, there's a reform which may or may not cause another crisis. If it causes another crisis, then they try again. And we'll see that even though the policymakers, and certainly the policymakers and maybe even the politicians sort of understand what the previous data mean, they're often misinterpreted. And then if you misinterpret what got you to where you're going, you're going to put in the wrong fix. Okay, so the key player in this is the 30-year, or if we go back to the 1930s, the 20-year fixed rate mortgage. That's sort of the traditional mortgage that you can get for a conforming one, say, or a jumbo one, where it has fixed amortization over 30 years. The interest rate is fixed, and in the United States, at least recently, say since the 1960s, not that recently, you can refinance it without a prepayment penalty. So that is a remarkably, quote, stable mortgage to be a borrower from. But if you're the borrower, that's good. It's not so great if you're the lender, it turns out, if interest rates move around. So we'll see how the 30-year fixed rate mortgage, is it good, is it evil? We'll see. It took a long time to cause trouble. It caused trouble basically from 1975 to 90. That's the United States savings and loan crisis. It caused problem to the Silicon Valley Bank and the First Republic Bank, particularly First Republic, in 2022. And we'll see why the current period, the post-2020 period, is even worse than previous ones. Because it wasn't just housing policy, but monetary policy that got involved. So, I don't know, it's a little bit hard. The good and evil, I don't know. So, if you've all seen The Godfather, Mr. Corleone, Michael Corleone, he's the son of the mafia Don, and he seems like he's a really nice guy, and maybe he could become, a certified public accountant or, a Boy Scout leader or something like that. And it looks like he's really a nice guy. But then it turns out after he hangs around with the wrong people, he's back to being a mafia Don. So 30-year fixed rate mortgage is a lot like that. And then people thought that you shouldn't let the 30-year mortgage hang around with short-term funding. Short-term funding is a thing that causes financial crises. So people thought, just keep the 30-year mortgage away from the short-term funding and they can be the head of the Boy Scouts instead of the head of the mafia. We'll see that misses the point. Okay? So now this is the history. So you didn't know I was a history professor, but I am. So the U.S. housing policy basically started in 1932. So if you remember, the details, so the financial crisis, the Great Depression started in 29, but that was still the Hoover administration, right? So in 1932, it's still President Hoover, and between 29 and 32, there were lots and lots of defaults on residential mortgages. Residential mortgages at that point were short term. They were like you'd get a 4-year or a 5-year mortgage. At the end of 4 or 5 years, you'd have to go and refinance it, apply for a new mortgage. And a lot of people lost their jobs in the Great Depression. So there were a lot of defaults on these mortgages. Not because people didn't want to pay, it's because they couldn't pay. Okay, so there were many foreclosures due to mass unemployment. People were losing their houses. And then even in the Hoover administration, which is, not a particularly lefty administration, they thought that really this was sort of unfair and the government should do something about it. So in the Housing Reconstruction Finance Corporation, the RFC, would go up and buy defaulted mortgages, 5-year, 4-year mortgages, put them on the government balance sheet, partially forgive them. This is sort of like stuff that was talked about during the Obama administration. Partly forgive those mortgages, cut the payments down. So let's say, you had a mortgage for 100, they'd cut it down to a mortgage for 40, and you'd only have to pay 40% of the payment. Okay, so that basically allowed people basically you could foreclose on every house in the country, but then who would buy it? So essentially they did this to sort of cut down on foreclosures, and that was the first time the U.S. federal government got involved in housing. At the same time as this, in the same law, they set up the Federal Home Loan Banks, which were set up to lend money to traditional banks if they had liquidity problems because they had too many mortgages, or if they had funding problems and wanted to make more mortgages. Okay, so the Federal Home Loan Banks have had huge mission creep. They have almost nothing to do with housing anymore, but I don't have time to talk about that one. Okay, so the first intervention was, and it was a super sensible one. We go into a depression, people can't afford their mortgages, we don't want to sell everybody's house to nobody, so we then just cut the things down. The other thing they did was they brought in the 20-year fixed rate mortgage as the new solution. They sort of encouraged and through regulations almost required mortgages to be 20-year fixed rate, fully self-amortizing. So that then, because they thought that the real problem, which was part of the problem was the 4- and 5-year balloon mortgages, which were around before that. Okay, so that was pre-FDR. So then let's talk about 1934 to 75. So in 1934, under Franklin Delano Roosevelt, we had the National Housing Act. It established what was called the FSLIC, the Federal Savings and Loan Insurance Corporation, which is like deposit insurance for savings and loans. Savings and loans were set up to be an institution which made cheap, keyword cheap for the households, 30-year fixed rate mortgage and financed them what were called passbook accounts. Passbook accounts are short-term, they're basically they're like demand deposits, except you can't pay your bills with them. In those days, they didn't have computers, so you had a little book that they would stamp and keep charge of your balance and record it in the bank's ledgers. But think of it as like checking accounts. And they had interest rate ceilings on them. So the idea was, you want cheap mortgages, just don't let these guys pay much on their deposits. They'll pass that along to the mortgage people, and it'll be a way of subsidizing home ownership, and that's the American dream, or something like that. They also set up the Federal Housing Agency, the Federal Housing Authority, the FHA, to encourage low down payment lending. So that's going to be a theme in the future, that in some sense, if people can't afford to buy houses, maybe instead of giving them some money, you just let them buy houses with a smaller down payment. So that improves access, but it also puts these households who got these mortgages with very little down payment at a lot of risk of losing their house. But the net was that they thought it was worth it. And it also makes the lender at risk of not getting paid if the people with 5% down can't pay. But that'll be the government's problem. So the FHA essentially insured those mortgages against default. Okay, so in all this period, they encouraged not the 20-year mortgage. This was the period starting in this National Housing Act. They encouraged the 30-year mortgage. It's a good mortgage. You know, he's not going to be a mafia don. He's going to be a Boy Scout leader. Okay, so then U.S. housing policies, essentially, the savings and loan promoted subsidized finance. It worked really well. It worked really well until the late 1960s, and it blew up. In 1960s, interest rates went up some, and these interest rate ceilings, the savings and loans weren't allowed to pay more than 4% on their deposits. The banks were not allowed to pay more than 3.75%. So the idea is that the savings and loans could pay a low amount, but it was above what the banks could pay, so it would give them some access to money. That worked well until the 60s, and it totally blew up in the 80s when the savings and loan crisis occurred, because the interest rates went way up. So the savings and loan crisis was a big deal. It had huge effects on the way that there's regulation and supervision of the mortgage markets and the financial institutions in the U.S. So the interest rate increases we had a lot of inflation then. Interest rate increases made the savings and loan industry and 95% of the members of the industry insolvent. So the industry net worth, by the time they failed, was around minus 25%. That's very insolvent. And the U.S. taxpayer, and then they didn't, during the Ronald Reagan administration, they sort of didn't want to close these savings and loans, because if they close them, they need to have enough money in the Federal Savings and Loan Insurance Corporation to pay this big loss. It had about 5% of that amount. So they really didn't want to have the Federal Savings and Loan Insurance Corporation default. So they decided they'll wait. And in the first weeks of the George H.W. Bush administration, they finally closed these guys down, and they basically worked on getting a bill to pay the bill. And the losses on deposit insurance for the savings and loans were $123.8 billion. That's $945 per capita in the United States. That's a lot of money. So basically, some people concluded deposit insurance, it's a bad idea. Okay, deposit insurance on insolvent institutions, I agree, that's a bad idea. In my other day job, I point out deposit insurance is actually a good idea because it prevents bank runs, right? If you think your bank is illiquid and everybody else has taken their money out, if it's insured, don't worry. If they're a little bit insolvent, if it's insured, don't worry. Otherwise, if there's going to be a bank run, everybody expects that there will be a bank run. So deposit insurance is a good thing. This is a lot to pay for it. It shouldn't cost anything close to this. It should be pretty much self-financing by the various banks and savings and loans in their premia. Okay, so the savings and loan crisis, people could say, who could have thought what would happen if interest rates went up? And how could this thing ever blow up? Okay, everybody knew it could blow up. And so I mentioned I worked at the Fed in the 1970s as a graduate student. So in 1976, I was hired at the Federal Reserve Board in DC to build a model of what would happen to savings and loans if interest rates went up. The interest rates were up a little bit, but they weren't up that much. At that point, interest rates, long-term interest rates, around 5%. Okay, they went a lot higher than that. So they actually hired me to fix somebody else's model. I spent half a summer trying to fix that model, realized I couldn't fix it, and spent a couple of weeks, built another model that worked. Then they hired me back 2 more years to maintain my model, which didn't have any problems. So thank you. The Federal Reserve actually put me through graduate school through this. So the savings and loan crisis has a soft spot in my heart because it got me this funding when I was in graduate school. So interest rates were 5% in 1976. My model showed that savings and loans would become insolvent at 11%, if it just stayed at 11% for 5 years. The rates went to 16.3% in May 1981. Okay, they didn't start closing these guys for like almost another decade. So all of these institutions were in business, insolvent, and they started doing crazy things, stealing money, investing in tremendously risky stuff. In fact, savings and loans were paying interest rates on insured deposits that were above Treasury rates. So you should say the Treasury is insured, savings and loan stuff is insured. So if the Treasuries are paying 16, they'd pay 18%. Okay, why was that? Because they were losing money and they had to stay in business. So if you want to stay in business and you're losing lots of money, you got to raise more and more money. It's sort of like the way Ponzi schemes work. So they had to keep competing with each other insolvent institutions to pay more and more on their deposits. So if you talk about regulatory failure and government failure, this was like right at the top of the stupidest things that were ever done. In this case, not for corrupt reasons, just because it was sort of politically embarrassing to realize it was going to be this $945 per household. So my model that I built showed that floating rate mortgages were the only answer, because if you tried like long-term deposits, 20-year deposits, there was not any household demand for them. You wouldn't be able to run an institution like that. So financing mortgages, particularly sort of subsidized mortgages, with long-term financing wasn't a fix. So basically nothing was done. People saw this happening. Lots of people I knew in the Fed, outside the Fed. Later, when I was teaching at Chicago, everybody knew that this was happening, but nothing was done, partly due to political pressure. So what did the policymakers take away from this? They took away that the 30-year fixed-rate mortgage funded by short-term deposits, that's a problem. They didn't say there's anything wrong with a 30-year mortgage. It's a good mortgage. It's going to be, take care of the Boy Scouts. But if you just keep them away from short-term funding, you'll do okay. So then a lot of laws came into effect, reasonably well-crafted laws. The Federal Deposit Insurance Improvement Act, the FDICIA, if you ever heard of that, was passed, that made the banks hold more bank capital, more equity against mortgages, encouraged more sales of mortgages to the government institutions like Fannie Mae and Freddie Mac and the other one. So that was good, but the rules didn't actually measure the amount of bank capital that was around today as a function of interest rate changes. I'll walk through what that means, but just to see how this is ironic, the savings and loan crisis worked because savings and loans stayed in business for insolvency caused by interest rate increases. The interest rate increases increased their cost of funding, made them insolvent. There weren't defaults on these mortgages. There was a period of such high inflation that mortgage holders, people who owned houses, were getting a huge subsidy because the inflation was inflating away their debt and their house price was going up. So they weren't underwater mortgages, they were underwater savings and loans. So interest rates went up, savings and loans became insolvent. Okay, why didn't they have to close them? Because they used hold-to-maturity accounting. They used historical cost accounting. So they're going to say, even though their funding costs have gone up, we don't have to take it. So they lose a little money paying a little extra out today on deposits, but the present value of the stuff in the future, who knows what the future is going to be. Interest rates are 16% tomorrow. They could go back to 3% the day after tomorrow. No, it's not true. So the savings and loan crisis occurred because they didn't use effectively mark-to-market accounting for bank capital. So they put in higher capital requirements, but they didn't put in mark-to-market accounting for the bank capital. So when your interest rates go up, your solvency goes down. You don't have to raise any more equity. You don't have to slow down your growth. We just use hold-to-maturity accounting. Okay. Hold-to-maturity accounting was how the Silicon Valley Bank and the First Republic Bank run occurred. I'll talk about that in the future, because They were insolvent on a mark-to-market basis, but they were well capitalized on a hold-to-maturity basis. Why? Because they had long-term assets whose value went down when interest rates went up in 2021, 2022, and 2023. Okay, so if you think about sort of a ironic thing, they had a crisis caused by interest rate risk not being mark-to-market, and they say more capital, but not mark-to-market. Okay, so that is like, you don't get bigger screw-ups than that one. But the missing takeaways is that 30-year mortgages don't mix well with increased interest rates due to inflation. So even if you don't fund long-term, fixed-rate mortgages are a source of insurance for homeowners, right? They're insured against interest rate increases. So if you think about housing policy and stable mortgages and making sure households don't get into trouble during a period of high inflation, 30-year mortgage is great for the household, but it's sort of not a free lunch. It's not so great for the lender. So if the lender could be Fannie and Freddie, it could be a savings and loan, which basically no longer exists now. It could be a bank. This only works well if we have good monetary and fiscal policy that doesn't have interest rates going up a lot. So you can give people insurance against interest rate changes. If interest rates don't change very much, sort of monetary and fiscal policy can sort of make sure that interest rates don't have to change very much. Maybe for a little bit of macro stimulation or not, you can move it around, but you're not going to go from 3% to 18% probably. That's about inflation. That's about nominal rates, not real rates. So if 30-year if future rates are uncertain and we had unsubsidized 30-year fixed rate mortgage, they'd be super expensive and priced out of the market. Okay, so we're going to see, I'll talk about how we gave free insurance to households against this, and that's coming in the future. But if there wasn't government intervention, the 30-year fixed rate mortgage would be great for households because it's safe, but it would probably be so expensive. Probably right now a 30-year fixed rate mortgage without government subsidies would be like at 9% or something like that. At 9%, you'd take a 7-year ARM or a 5-year ARM, at like 5%. But if they're both at the same rate, and then you look recently, in many cases, the 30-year fixed rate is below the 5-year ARM, which is like, there's no possible set of interest because you can refinance essentially for free. There's no undistorted market equilibrium that ever has that happen. So for sure there's distortion. Okay, so the missing takeaway was they gotta be concerned about future losses if interest rates go up if you have this 30-year fixed rate mortgage and you don't make the banks and savings and loans market to market. But as it turned out, they got lucky, and with a couple of exceptions, interest rates just fell for the next 30 years. So basically they made a huge mistake, but somehow God or someone else made sure that it didn't become a problem because interest rates just kept going down. Okay, this is just the short rates. Let me just show you the short rates. So this is, interest rates were low for a long time. Okay, this is the savings and loan crisis. Okay, then they go up and down, but pretty much they were going down from 17% down to 0% over that period. So if they're going down all that time, you made a mistake, but it's not a problem. In fact, you did a nice favor for the banks, because the banks in most of that period were charging more for the fixed rate mortgage than the floating rate mortgages, and they only locked in the interest rate until the next refi, which was probably 6 months later. So it was actually good for the banks, and since there were savings loans left at that point. And it was sort of good for the households ex ante because they had insurance, but they had insurance against something that didn't happen. Okay, so, you could say you buy fire insurance against your house and you feel bad that you didn't collect, but you should be happy if you didn't collect, right? Because the way you collect on fire insurance is your house burns down. That's not good. So 30-year fixed rate mortgage is like buying insurance you didn't need, but because you didn't need it, it didn't screw up the banks. Okay? We're going to talk about I'm supposed to record this, I guess. Well, you won't hear me for a second. I can shout. We're going to talk about this period a little later. I don't want to show this slide. Interest rates were 0 in this period. There was something called quantitative easing going on in here. I'll tell you what it was. So we made another huge mistake over here. So we made a huge mistake here, which we didn't get called on until basically here. Okay, so I mentioned this was about monetary policy too. You need, to really screw this up, you need not just bad housing policy, you need bad monetary policy too. Okay, so that's about interest rates. There are other ways to screw up in mortgages, even without interest rate changes. So the 1990 to 2008 period, we had this thing called the Ownership Society. It was part of the George W. Bush administration. So, and also in Congress and also in the private sector, we mentioned that we want to encourage, home ownership is a good thing. Some people don't have the down payment. So we saw the FHA and created the government insuring mortgages that just had small amounts, 5% down and things like that. They wanted to go even further than this. So the ownership economy encouraged home ownership among low wealth households by bringing in the zero down payment mortgage. Okay, so you have no value at risk there. You have, you get the house, and if you default, you default. They weren't so great in foreclosing on these things, so you default, you live there anyway. So that certainly helped those households. They had the 2003 American Dream down payment subsidy for first-time home buyers. So if you're getting a mortgage that wasn't necessarily FHA, you wanted to borrow from somebody else, somebody who was going to sell it to Fannie Mae or Freddie Mac, the government would gift you a down payment. Okay, so this encouraged home ownership among people who sort of couldn't afford home ownership, both because of the volatility of their earnings and because of low net worth. So, and then the private sector said, oh, you want us to make some lousy mortgages? We're happy to do that. We'll make sure we don't hold them. We'll sell them off in securitizations. So we brought teaser rate, floating rate loans where you'd pay, say, 0 for 5 years, and then it would go to 250 basis points over 2-year treasuries. So it would go to like 5%. 0, 0, 0, 0, 0, 5. We'd have private securitizations. We'd have a huge amount of subprime mortgages. What could go wrong? What could go wrong? So this was clearly a policy thing. The private sector definitely participated, but it was encouraged by FHA, encouraged by Fannie Mae and Freddie Mac. My former thesis advisor was on the board of, Steve Ross was on the board of Freddie Mac and told me at the time that there was a lot of pressure on them to be more like the FHA. Okay? So what could go wrong? Well, the great financial crisis in 2008, and it wasn't directly caused by mortgages, but it was caused by private mortgage-backed securities. So in 2008, due to defaults and feared defaults on subprime mortgages, mortgages were the problem because people weren't paying them. There were a lot of mortgage fraud. There was a lot, people who claimed that they had a job and didn't. People who claimed that there was a third party putting in a down payment but didn't. And then this caused problems which eventually brought down Lehman Brothers and things because the mortgage-backed securities that had pools of these subprime mortgages and they tranched them into senior claims and the junior claims, people thought, turned out wrongly, people thought that even the senior claims on these would go into default. And if the senior claims went into default, lots and lots of the world's financial institutions would be insolvent. Most notably Lehman Brothers, but Goldman Sachs, Morgan Stanley, Citigroup would have been insolvent if these senior claims had gone into default. And the secondary market of these senior claims on the subprime mortgage-backed securities were dropped like a lot. Surprising fact, there was essentially no losses ex post on the senior claims, but everybody thought there were going to be losses on the senior claims. That's partly because various US government interventions into the housing market and writing these things down and having the government buy things up and changing accounting rules and things prevented this from turning into Great Depression version 2. But the fact that everybody thought this could happen caused this tremendous problem. Okay, so then Lehman Brothers failed, and then we had a nice financial crisis. The stock market went down. It was quite expensive. And a lot of people say, gee, the banks lost a lot of money. Well, we'll talk about the actual government bailout and who got the money in a bit. Okay, so the big policy takeaway after this was that floating rate, teaser rate mortgages and private securitizations were the problem. Not my friend who's still not with the Boy Scouts, the 30-year fixed rate mortgage. In fact, they decided the 30-year fixed rate mortgage was a good thing because it provided stability against interest rate changes, and it also was like easy to understand. So the thing about teaser rate mortgages, 0% for 5 years, and then some 2.5% plus some number you never heard of, was so hard for people to understand. So just tell them the interest rate is X% and it's fixed for 30 years, fully amortizing. That was thought to be good for consumer protection. They thought it was be good. It should just be encouraged. Okay, so the lesson they learned after 2008 is these funky mortgages are hard to understand. They're bad. Private securitization, they're bad. So let's just make sure the stuff goes back to Fannie and Freddie. So the law that they passed, I should mention that a group of financial and macroeconomists formed something called the Squam Lake Group. Ken French from Dartmouth was the person that started it. I was on it. Raghu Rajan was on it. John Cochran, a lot of people. 16 of us or something. So we proposed all kinds of new financial regulations, which they did about 4 of, and they did about -4 as well, the exact opposite of what we said on 4 others. So one of the things they did that we did not encourage was to encourage all mortgages to be 30-year mortgages through changes in the way banking supervision and regulation has. So we mentioned banks don't like to have extra equity capital backing something up. They'd rather finance it with deposits. So they put a higher capital requirement on any mortgage that wasn't a conforming 30-year, not conforming like below jumbo, wasn't a 30-year fixed rate fully amortizing mortgage. So you could take a 5-year floater, which is less risky for the bank. You'd have to have a bigger capital requirement on that than if you had 30-year fixed rate. So the 30-year fixed rate, it's a good mortgage. It's going to be a Boy Scout. So then what did they do? They set up a recapitalization of all the GSEs. So that's Fannie Mae, Freddie Mac, and the FHA. They also bailed out General Motors at the same time, but that didn't have to do with mortgages. That had to do with union politics. So the GFC bailout for those people, hardly any banks in there, essentially no banks, cost $498 billion. So that's $3,837 per capita. So this is, even adjusted for inflation, a lot more than the savings and loan crisis. A lot of people said, these banks brought the system down. So no, it's these GFCs, the Fannie, Freddie, and FHA that brought the system down. Okay, why? Because they were the ones effectively guaranteeing these crummy mortgages, which largely defaulted. And housing, this is like housing finance related. So this was like a major screw up. So they managed to find a way to lose a lot of money in a period when interest rates weren't shooting up like mad. Okay, so they lost money in the past through interest rates. Here they just lost through default risk. Okay, and government guarantees a default risk. Okay, so that was screw up again. So, I mean, at least they're consistent. They get it wrong every single time. So 2010 to 2022. Okay, so we have low and falling interest rates. Okay, eventually, so they went to 0. They went to 0 and then back to 0 post-COVID. And that is, in certain sense, a policy subsidy to long-term interest rates. If interest rates are down, going down, and going to stay down, that'll by itself bring down the long rate. So they had this sort of loose commitment in Federal Reserve monetary policy called low for long. We're going to keep the short-term interest rate low, close to 0, and we're going to keep it there for a long time. We're going to give you what's called forward guidance, which is not quite a promise, a sort of promise with your fingers crossed. It's a promise that you won't raise interest rates. Okay, that is one way of bringing down long-term interest rates, because part of what long-term interest rates are supposed to do, in addition to having some kind of a risk premium, there's supposed to be some measure of expected future short-term interest rates. Because you can either roll over shorts and get something, roll over short-term loans, or you can hold the long-term. And the fact that you can do, there are 2 ways of doing similar things mean that long rates are related to expected distribution of future short rates. Okay, so the first thing that subsidized the 30-year mortgage through monetary policy was just bringing down interest rates. Then interest rates got to 0, and they brought in this second weapon, and this is the key one. This is where the rabbit goes into the hat for the fact that this is a problem. They brought in quantitative easing. What is quantitative easing? The Fed buys long-term U.S. Treasuries, and I'll tell you some other stuff they bought in a minute, buys long-term U.S. Treasuries and finances them with short-term debt, effectively with bank reserves. Okay? So this brought down long interest rates more. So this is a subsidy to all long-term borrowers, and I'll say some more in a second, but in addition to buying long-term treasuries, they bought long-term mortgage-backed securities, which was a subsidy to Fannie and Freddie and the FHA, which got passed along as a subsidy to households who wanted to borrow with 30-year fixed-rate mortgages. So interest rates are down, and you can imagine if interest rates are down, you thought they'd go back up, the yield curve would be upward sloping. Long rates would be above short rates because everybody expects and everybody knows they're not going to stay at zero forever. So to get more long-term borrowing, I don't think because of housing, they were thinking firms, they're going to push down the long rate. They could have pushed the long rate down to zero if they want to. They said buy all the long-term bonds. If the government or the Fed owned 100% of the long-term bonds, the interest rate is indeterminate. If they want zero, they can have zero. They want minus 10, they can have minus 10. Okay? So the Fed bought long-term mortgage-backed securities, long-term treasuries, and this makes sense only if the 30-year mortgage is actually a good mortgage. It's not, it's going to be the Boy Scout leader and not the Mafia Don. So basically, let me make this point about QE as a form of free insurance. I started about free federal flood insurance. Here's where I'm bringing that point back. Fixed rate mortgages that can be refinanced in the future without government intervention would exclude a huge premium for this option. If interest rates go down, you refinance. If interest rates go up, you hold. That's an option. That's really valuable option. It's insurance against, it's better than insurance against interest rates. You have insurance against interest rate increases and a gain from interest rate decreases. So 30-year fixed rate mortgages with that option should be damned expensive. If you figure interest rates are zero and they're not going to go lower, you can predict the direction of future change, right? It's going to be up, because you can't go lower. Maybe they could go to minus 2% like they did in Europe, but they didn't actually do that for things like mortgages. They did it for bank reserves and stuff. So basically, interest rates can't go below zero. They're at zero. 30-year fixed rate mortgages should have interest rates way above zero. They should be like 7% or 6% at that point. Okay, so the government's buying mortgage-backed securities, buying treasuries, flattening the yield curve. They're effectively giving free insurance against interest rate increases. So it's no wonder that the 30-year fixed rate mortgage, in addition to these things that it had lower capital requirements and less regulatory scrutiny, it just became a compelling deal for households. So quantitative insurance, quantitative easing was this free insurance, and it totally messed up the mortgage market. Totally messed up the mortgage market. Let me see. So the Fed bought this stuff, and then there's nothing wrong with the Fed doing this. It had these unintended consequences. But the Fed, if it does this and it buys the long-term rates, pushes them close to zero, if interest rates go up, the Fed's going to lose a lot of money, right? So they're going to, it's not a free lunch. It's just the Fed or the government. The government could have done it by changing the maturity of things it issued. The Fed or the government could have done it other ways, or they're going to lose money in the process unless interest rates go below zero, which wasn't going to happen. So let me show you here from last week. This is the Federal Reserve's cumulative net income, the amount of losses that they have incurred from quantitative easing. So they lose $1 to $10 billion a month. The losses since October of 22 exceed $240 billion taxes. Billion dollars. You can imagine, that's a lot of money. That's a lot of money. It's not a mistake that QE may have had good intents, good idea. It may have been a good idea. It was designed to lose money, but it lost a lot of money. So this is the ex post cost of the quantitative easing subsidy to long-term borrowers. As I said, much of it went to borrowers via the Fannie and Freddie. So as I said, some people say this is fine because if you push down interest rates, the government just issues long-term debt at a cheaper price. So it's basically a subsidy to itself. If they just bought treasuries, that would have been true. If they say, okay, bring down interest rates, the government can issue long-term interest rates at a lower cost. Then they're going to have save some money today. They'll pay some more money in the future. It's just an in-house transaction. But because they bought mortgage-backed securities, a non-trivial fraction of the subsidy of this free federal homeowners insurance, free federal flood insurance, essentially, floodplain flood insurance, went to borrowers of conforming mortgages. And QE is not going to happen anytime soon, partly because these losses prove to be controversial. You don't see these, thankfully, you don't see these like this little chart like in the Wall Street Journal all the time. Nobody's chosen to run on this, run in the sense of bank run or run for office. But let me just so you don't go home and decide the world is even a worse place than you thought. Say the interest rates are going down now. They're not going up. So that thing I just showed you before, that's the cumulative losses. These are the per month losses. So the per month losses were sort of the worst in around March of 23. That's when the Silicon Valley Bank was run. So March of 23 is sort of right in there. But if you see it's sort of converging back up towards zero, and the Fed predicts, if you use the Fed's dot plot predictions of future interest rates, this number is going to go through zero again pretty soon. So we didn't lose much. We only lost like 240 billion, but at least we've cut our losses. We're not going down anymore. Okay, so why am I showing you this? I said it was a subsidy. If you just buy one security with another security, how is that a subsidy? Here's where the bill came. So the US government policy subsidized 30-year mortgages from 2010 to 2022. And like I said, flood insurance is a good thing, right? Because a big flood might, let's say on the Atlantic Ocean or hurricane insurance, that might bring down insurance companies. So maybe the government is a natural provider, but subsidizing it encourages socially bad behavior, building mansions right along the ocean, right along the Mississippi River. So QE is like subsidized flood insurance. And to understand what's happening today, suppose we had subsidized flood insurance, but only for the current owner. The new owners couldn't get it. Right? What would happen? Nobody would buy or sell houses by the Mississippi River, the Atlantic Ocean, or the Gulf of Mexico anymore. Right? Because then you got free insurance. The next person has non-free insurance. The next person's going to pay an amount based on non-free insurance. You won't get much for your house, so you'll just stay there. Okay. Substitute 30-year mortgage for free insurance. That's exactly what's going on in the market today. So the other unintended consequence of this subsidized 30-year fixed-rate mortgage is it totally screwed up the actual housing market, and it turns out it sort of screws up the labor market as well. So I mentioned that there was a lot of subsidies to 30-year mortgages. So 97.1% of US mortgages are 30-year fixed-rate mortgages. So the 30-year fixed-rate mortgage is a goal of government. Seems like it's a good thing to make it safe. It's a good mortgage. It's going to stay with the Boy Scouts. But housing markets are going to dry up. We saw that there's a professor, Lou Liu, at the Wharton School, who basically showed that you can understand lack of mobility in the labor market from keeping track of who has a 30-year fixed-rate mortgage. People have 30-year fixed-rate mortgages turn down better jobs that are even 2 hours away or 1 hour away because they won't sell their house. So not only does it screw up the housing market, it screwed up the labor market. In addition, monetary policy doesn't work as well as it used to. It works differently. So normally they say if you raise, when I was in graduate school, it's like, how does monetary policy work? You raise interest rates, it screws up people buying cars and it screws up people buying houses. That slows the economy down. It still screws people up buying cars because we didn't have 30-year fixed-rate car loans because cars don't last 30 years. But it did screw up monetary policy. So we've raised interest rates a lot recently. And what happens? House prices are still going up because the reduction in supply, because people are locked in, is bigger than the reduction in demand. So it's all about supply and demand. So if supply drops more than demand, the quantity goes down and the price goes up. That's housing markets in the United States today. In addition, this whole thing about encouraging 30-year mortgages and back to what I said about the savings and loans, not marking bank capital requirements to market when interest rates go up, encouraged Silicon Valley Bank to buy US medium-term government agency securities encouraged First Republic to make tons and tons of 30-year fixed-rate mortgages, in their case jumbo ones, because they said, look, they're not going to raise interest rates, and it's pretty safe to do this. The government wants to do it. We're good citizens. Interest rates go up. Said, hey, our capital is fine. We're well capitalized. Unless you market to market, then we're negatively capitalized. So if you think about the Silicon Valley period, it can be, because it's all working through this quantitative easing, and in the case of First Republic, work through the 30-year mortgage, it all follows back to well-intended policies. So the 30-year mortgage was tremendously overhyped. It only dominates today because of government subsidy and regulation, but they're very, very politically popular. Suppose someone, I'm going to get rid of the 30-year mortgage and bring back the one-year ARM or something like that. I think that person would not win. So the market is going to take a very, very long time to unfreeze. Like most of the mortgages right now are very low rate mortgages, right? And they were, a lot of them are 5 years old now, so they're 25-year mortgages, but 25 years is a long time. Rates are not going to go back to 3 or 4% anytime soon, right? So basically, to get mortgage rates back to 3 or 4%, we need something like quantitative easing again, and we need poor regulation for jumbos, and we need the government to stop running huge deficits. If the government's running huge deficits, there are two ways to avoid that. If you don't stop running the deficit, there are two ways to respond to that. One is you can default on the debt. That wouldn't be great. The other thing is you can inflate it away. That's a lot easier. It's sort of like, it's like a non-default default. It's because you got to lower the real value. The government, the economy has a certain amount of real value. There's a certain amount of real taxes the government can raise. We got way too much debt. We got to bring it down. If we bring it down, we got to pay it. We don't want to pay it. We don't want to raise taxes. So just inflate it away. Just inflate it away. So some people who are not fans of the Trump administration say, Trump administration doesn't understand that if they cut interest rates to zero, that'll cause inflation. And that'll result in higher long rates. I'll come back to that point in a minute. That's true. That's true. But the government has a lot of long-term debt. They've actually been shortening it recently, which I don't quite understand. A lot of long-term debt. If the government doubled the prices or tripled the prices, debt to GDP in real terms would be fine and dandy. So I think it's not so stupid what Trump is asking, cut interest rates to zero and let's make inflation great again. But I think that's not the right thing to do, because inflation is a bad thing. We just had a tiny little bit of inflation a few years ago and people went bananas. I mean, you all, most of you are close to, some of you are in my generation, I'll put it that way. So you remember the big inflation, and it used to be you'd have to get to the store, before 2 o'clock when they raised the prices, right? So that's a general problem. So that's my takeaway. So if I was going to talk, if this was a group interested in monetary policy, this is how I usually scold people who are macroeconomists. So monetary policymakers generally forget that the way interest rate changes actually work is not the way they think it is. The way macroeconomists think is interest rate goes up, people invest less, people spend less, they save more, and things like that. Interest rate go down, the reverse. Interest rate, primarily the direct immediate effect, and I would argue the main effect, is through changing the way individuals and firms actually finance themselves with financial instruments. So monetary policy is not just about inflation and unemployment, it's about finance. So I'm a finance professor, so I think we're misunderestimated, as George W. Bush said. So basically, the distortions of the way monetary policy like QE affects finance has long-lasting effects, because people write long-term contracts in there, and if you realize you screwed up, those long-term contracts still around to cause trouble. So I mentioned this low for long promise that they would keep interest rates low and not raise them for a long time. That helped seed the great financial crisis. And a lot of these policies that are sort of forward-looking in a loose sense screw up the future more than they screw up the present. And people, I think, I'm glad I'm not chair of the Fed for a number of reasons, but I think I would be very much against the short-term focus on the long term. So they say, we care only about the long term and we're going to talk about the future. But you got to say, if you're committing yourself to stuff in the future, people are going to do things in the present that screw up the future. So policies subsidizing long-term mortgages caused the S&L crisis. They caused the recent lock-in. They caused the Silicon Valley Bank. And that's a general problem with not just housing policy, but monetary policy. So this is sort of an obvious thing. There's a lot of I alluded to this a minute ago. There's a lot of pressure on the Fed to reduce short-term rates. So as I say, the White House motivation is to bring down mortgage rates, which is always politically popular. I would guess the only sensible thing is to deflate away the debt. You'd never say that, right? And I mean, I don't know. I can't, psychoanalyze the President of the United States. But bringing mortgage backs to 3% would indeed reduce lock-in and improve the housing market. But cutting nominal rates to 0%, causing a hyperinflation, that would not bring interest rates down. It would actually raise them. So mortgage rates are long-term, and of course, if you raise inflation, nominal interest rates will go up, and it'll inflate away not just the value of the government debt, it would also inflate away a lot of our 30-year fixed-rate mortgages. So those of us who were subsidized when we got the mortgage, we get some inflation, we'll get another subsidy, but we're the ones who don't deserve it. So it would actually, all of those things would hurt home buyers, reduce housing sales and turnover. So cutting interest rates to zero, you don't need to be a PhD economist to realize that's a really bad idea. But there is at least one PhD economist who's currently working at the Fed and has a day job as well, who thinks it's a good idea. So again, with friends like the government, you don't need enemies. And if you're a home buyer, even though all these things were well-intentioned, just thinking about monetary policy, finance, and stability are three things that you can't think about separately, which tends not to be the case for most people. That's an important lesson for understanding the present and the future. Thank you very much.
Thank you. So I think we have time for maybe one or two questions at most. So anyone, a question? Yes, please.
In view of the current administration's tendency to want interest rates changed to lower interest rates, what's to prevent what are the safeguards that could be put into place to avoid Erdogan's problem in Turkey by doing that?
So I would put it the opposite way. I'd say if that happens and we get like a big inflation, the next best thing to do once you've done that is financial repression, which is sort of what's going on in Turkey and what countries usually do when they get high inflation. So basically make sure that even though inflation is 12%, that you and me and things can't get returns above 6 or 8%. Give us a negative return. So that would be, I think that's the bad scenario. If you get into the scenario where you get this big inflation, you could try to cut the inflation, which would require really tight monetary policy, like the Paul Volcker policy. So I don't think, I don't know. I'm guessing it's not going to happen. So I have faith that the Supreme Court is not going to let Trump fire all of the Federal Reserve. So if I'm wrong on that, then we need to start thinking more about the question you just asked. But I'm guessing that even if you got people who were really truly believing that cutting interest rates was a good idea, to zero was a good idea, if we actually started to get the inflation, my guess is just normal old-fashioned politics would put a brake on that. But I tend to be an optimist.
Yes.
I want to go back to the point on mark-to-market accounting. If you look at GSIB banks, Adaphone, that are required to, would you be in favor of expanding that to other banks, and what impact would that have on their balance sheet? When you look at some of the regional banks, the smaller banks, that are the backbone of running and lending and creating liquidity.
So I think mark-to-market accounting. Oh, okay. So the question is, the really big banks, the G-SIBs, through their stress tests already have something like mark-to-market accounting entering their capital requirements. The smaller banks don't. The really small banks have two types of assets they don't have to mark to market: the hold to maturity and the available for sale. The mid and big banks have to mark the available for sale assets to market. So mark to market just means interest rates go up, the price goes down, and that directly affects your capital. So I think hold to maturity accounting and mark to market and not marking everything to market completely is a good idea, because banks' cost of funding doesn't go up 1 basis point every time the market goes up by 1 basis point. There's like what's called limited pass-through, or a deposit beta less than 1. So if interest rates go from 4 to 5%, the bank would pay you, who used to pay you 2, would go from 2 to 2.25% or something. They only pass through part of it. So they can, a bank doesn't have to be as you don't have to consider interest rate changes in their capital as much as you'd have to change solvency changes, impairments, loan losses, and things like that. But it doesn't say you shouldn't mark to market at all. It's like you should have if you have to mark, shouldn't mark 100% of the amount down. Instead of marking 100% of the amount down, you mark 40% of it down, because you know your funding costs are not going to go up completely. And but however, if your bank capital, if it were marked to market, ever got below like minus 1% or something like that, at that point you should start marking to market, because at that point, we had a run on the Silicon Valley Bank, even though their assets were U.S. government agency securities, very liquid securities. Why did we have a run? Because those liquid securities weren't worth par anymore. They weren't worth 100% of their value. So the value of their deposits was bigger than the market value of their assets, the liquid market value, the true God's truth market value of their assets. And the Silicon Valley Bank didn't have this limited pass-through thing of sleepy depositors, right? They had many multi-billion-dollar deposits, and they had most of their deposits coming from firms who were tied to one venture capitalist, so they sort of had one depositor there. So they were very special. So I think getting rid of hold maturity accounting for everybody is a good idea, but not making everybody mark everything to market, but saying there's a partial mark. And you think about this not as like an accounting thing. It's either marked or it's not. You're saying bank capital has to be resilient for a given institution to make sure it never operates as insolvent. If you can always borrow below market at a rate which is even bigger if interest rates are high, you can be a little bit insolvent and still be solvent, if you know what I mean, because it's not going to affect your funding costs. So I think they should be more intelligent about how they use market prices. Supervisors and regulators hate to use market prices because that's like the other team. They're the regulators that knows better than the market. Why should I bring those people on the other team? If I'm a Chicago Bears fan, I'm not going to bring in a consultant from the Green Bay Packers. No offense. Or vice versa, then I can be safe.
I think we have run out of time, so all good things must come to an end. So thank you, Professor Diamond, for your insightful talk. Let's give a big round of applause. We learned a lot about the evolution of mortgage here in the U.S. Also, thanks to, again, Bradley Foundation for supporting this event. And thanks to all of you for attending this. And we will have a few more events like this in the future, so watch out for some emails. So thank you again. Thanks.